Hello, everyone. Welcome to Mortgage Leadership Outlook. Andrew Berman from National Mortgage Professional Magazine and NMP TV. Thank you so much for joining us today. I am so honored to have the amazing Robert Broeksmit, the president and CEO of the Mortgage Bankers Association of America. Bob, thank you so much for joining us today.
Happy to be here, Andrew. Thanks for having me on.
All right, so listen, you and I were just talking about our mutual love for the summer. You've got a great tan. I mean, I got to say, like, that is, there's no question about it. You look like, I know you work your butt off, and this has been a tough year, man. The stuff that we had to deal with as an industry, and that you had to be actually, the ombudsman, when dealing with some unbelievable things that we had. There were some ugly times this year. But really, just the NBA had some great leadership. So I want to talk. I want to talk about some of the things that the NBA did in response to COVID-19. Where some of the unfortunate situations that we as an industry had to go through. But for those of you that don't know Bob's background, I want to get into it a little bit. I know you started out actually working in mortgage banking. You were a president or CEO for a vendor before leaving there and taking the helm back in 2018 over at the NBA. As a matter of fact, that's right. I forgot about this. You want to learn a little bit about Bob? This is an article that we did back in 2018 when he accepted the position for president and CEO for the NBA. That's right there. But Bob, so tell us actually, how did you originally get into the mortgage business? What sucked you in?
That's a pretty good story, Andrew. But first, let me tell you about the tan. I'm just following the CDC mandate to be outside as often as possible. Yes. So that's the result of that.
That's great. I'm with you.
My journey in the mortgage business started in 1985 when I graduated from Yale. And instead of working on Wall Street or going to a big consulting firm, I moved in with my brother in Short Hills, New Jersey, and I had good clerical skills, and I signed up with a temp agency. And my second assignment was with the Money Store, which some of your older viewers may remember was mostly a second mortgage and education lending shop, but they had a very small first mortgage division, and they needed some help. And I knew how to type, and we had an IBM Selectric typewriter, and I was typing verifications of employment, verifications of deposit, and processing loans. So while I didn't literally work in the mailroom, I pretty much started in the mortgage business from the ground up. And the nice thing about that is that I learned every function, because as a naturally curious person, I'd finish, say, processing a loan, and then I'd say to my boss, well, what happens next? And he said, well, Edna underwrites the loan. I said, well, what does Edna do? And one day Edna was out. So Stu Levy, who was my boss, showed me what Edna did, and then I knew how to underwrite. Of course, I'm oversimplifying for effect, but then I learned how to close and post-close and ship them to Fannie and Freddie and all that stuff. So I really learned this business from the ground up, and took on positions, of course, of increasing responsibility, but from a real practitioner's point of view.
So now, and when did it hit you? When did you well, this is interesting, I like this business? When did it go from just, pushing paper to, wow, this is something like it feels like it resonates with me and my personality?
Yeah, it's a good question, because it was a gradual process. I didn't start typing forms and say, I have to do nothing but mortgage banking for the rest of my career. But it really wasn't. I found that the field was so varied, and there was so much, no 2 days were alike. And then the notion that I was helping people either get into homes or save money via refinancing on their homes. So it had the societal good that was attached to it. And it also just provided me a way to learn so much about the field and, frankly, progress more quickly as a young professional in the mortgage business than I probably would have in other fields where they were just rife with Ivy League grads striving to take the next step. So some combination of that just kept me really hooked. And then after, I don't know, maybe I moved from New Jersey to Austin to work for a regional lender. And I thought, geez, I'm seeing the world and I'm doing interesting, fun things, and it's a way that is useful to society. And then I just never looked back.
That's great. So, I forgot to ask this. Like, what? So you went to Yale to do what? Like, what was your what? Because obviously it was not to be a paper pusher actually in mortgage banking. You didn't say I'm gonna go actually fill out forms on my typewriter. But what was your original intention when you started at Yale?
Well, like a lot of, I guess I was 17 when I started college. Like a lot of teenagers, I hadn't the vaguest notion what my plan was. What I really wanted was a great education in the liberal arts. I'm a history major and took all kinds of English classes. And it really taught me to communicate persuasively and to connect the dots and those skills serve me well to this day, I think. And it was not, how sometimes more recently families and college students view college as more of a vocational school. I'm going and majoring in business and here's what I'm going to do, as opposed to I'm going to college to learn how to think and to meet interesting people and learn a lot and be a citizen of the world, and then I'll figure out what to do. So I was much more of the latter, and that's what propelled me into the possibility, which is one I never would have considered. If somebody said, hey, how about you learn the mortgage industry from the bottom up, starting with being a temp typing forms for $8 an hour or whatever they paid me. I don't think I'd have said that was a satisfactory outcome for my Yale education, but it turned out that way. And I think my preparation was just to be open to that and to learn from any situation I found myself in.
Yeah, that's great. So now here we are, significantly after, decades after that. Now you have the perspective to look back. So I know you have two boys and a daughter, right?
Yes.
So would you encourage anyone to get into the mortgage business?
So this is a really interesting question, and one that as a parent, I think we all think about. And my short answer would be, it's a big, wide world. Don't do anything because I did it. Follow your passion. But as it happens, our oldest, who's a 22-year-old recent college graduate, had an internship with a mortgage-related concern and actually loved it. And he started a full-time job a week ago Monday in Atlanta with this firm. And so the only one who is so far old enough to have chosen a vocation is starting in the mortgage business, which is, I joke about it, and there's lots of other things one could do, but of course it's really gratifying for me, and I'm really excited for him.
That's great. That's awesome. Very cool. So when did the desire to get involved in leadership, when did that come about? Like what was when was the point of your career where you said, all right, something, this industry's been good to me. What do I do to help? What do I do? Like, when did that come about? And what was the driving force? I don't mean to kind of put my own assumption of why you did it, but what was it that caused you to get involved in whatever association you first got involved in?
Sure. So I had a long stint at Chevy Chase Bank and its mortgage subsidiary, which was called BF Saul Mortgage. I was there for 14 years, and it was in a lot of ways, an old school operation. It was a privately held bank. The family had been in the mortgage business for generations, dating to 1892, and the bank itself had been started in the 60s. And the bank then grew quite a bit, and the mortgage company became a sub of it. But so the real lifeblood of the organization was mortgages. So I was privileged to run BF Saul Mortgage for a long time. And I had the opportunity to be in Bethesda, Maryland, just down the road from Fannie Mae and across the river from Freddie Mac. And I found that as a mid-sized regional lender, we could punch above our weight partly because of our proximity to the agencies and my willingness to be active with them. And so we found ourselves in the middle of some really interesting innovation that the agencies were doing, and we were piloting. And I got involved with the Mortgage Bankers Association at that time. I was the years here in 1996 to 2010. And I found that I could influence the trajectory of this business by my knowledge of it and my proximity to Washington. As I say to people, since 1989, my local paper's been the Washington Post, and Washington manufactures nothing of substance, right? It's just politics. So I've been steeped in politics as sort of an avocation for decades, and it was really fulfilling for me to be able to speak to the needs of our industry as a practitioner, but as a leader at the Mortgage Bankers Association, to members of the Hill and the administration. So I came to, I got on ResBog, and then I was made vice chair and then chair of it in about 2005 and 2006. So that was really my journey to leadership.
So, and then where did you actually all of a sudden say, hey, listen, I want to get that to the next level and become, the president and CEO of the MBA? How did that happen? How did they find you and say, hey, listen, I know you have actually the successful job working for a vendor at the top position at a vendor. Why don't you come actually join us at the MBA?
Well, that's a really good story. I've known Dave Stevens for decades, back to his World Savings days, and I, of course, was aware that he had announced that he was going to retire from MBA, and I hadn't done anything about it. But I did have some people say, hey, you ought to throw your head in the ring. Or more to the point, they said the headhunter called, and I gave the headhunter your name, and then the headhunter did call and got me at sort of I didn't know the number, I called my cell phone, but I picked it up, and got me at I was running into a meeting, and I said, I don't know, send me the spec, right? I mean, I didn't say, oh, thank God you finally called. I said, send me the spec. And the way I'm sure a lot of your viewers do, I packed the stuff I hadn't been able to get to during the week into my briefcase and took it home to hope for a quiet moment over the weekend. And when I had that moment and read the spec, I said, holy smokes, this job spec describes me. And then my journey was to see if they really meant it, or that's just some puff piece that the headhunter wrote, right? So we went into this interview process, which was pretty intimidating. I went into a room where there were the 13 members of the search committee, and they're all prominent mortgage bankers from around the country. And so 6 on one side, 6 on the other, and then Rodrigo Lopez down about a mile at the other end of the table, who was the head of the search committee. And we did a first interview where very clearly each member of the committee was assigned a question, and they wanted to make it look spontaneous, but it's pretty clear they were asking the same question in turn to each candidate, so they could have some way of measuring who would get to the next round. Sure. And then at the next round, it was more of a homework assignment. It was, Bob, pretend this is your first board meeting and we're the board, and tell us what are the big issues facing the industry and how you think the MBA ought to respond to them. So I gave a little bit of a presentation, and then it really was spontaneous questions after that.
So what was that biggest issue? Well, so here you are actually. So I'm assuming this. So that was October. Was that 2018?
Yes.
Okay. So
July of 18. Yeah.
Okay. So what was that big pressing issue that you decided to talk about?
I haven't the vaguest notion. I can't remember. So much has happened. These 2 years feel like dog years, right? They feel like 14 because so much has happened. But there were all the usual concerns about which way were the GSEs going to go, and what about consolidation, and is technology going to disrupt the industry? I mean, I don't remember exactly, but those were the things floating around at the time, I think.
Yeah.
But the real, yeah, well, exactly. But the real thing that cinched the deal for me is that I was just myself. I was comfortable in my own skin, And I wasn't doing what I would have done when I was younger, which was to listen to the question. And even while the person was asking the question, say to myself, okay, what does this person want to hear? And then spitting that back, I said, wait a minute, this is kind of important, because if I get this job, I want them to know who I am. And I don't want to get it by trying to be someone I'm not. And that being genuine and vulnerable and authentic, which may sound obvious, but it hadn't been obvious to me earlier in my career, I think is what helped propel me to the position. And then nobody's surprised. They get what they thought they were getting, and I don't leave a nice position I had at Treliant for something that wasn't actually a good fit for me. So it was a really edifying process, and that's how I ended up where I am.
Yeah, because we listen to people talk, and we're thinking of like what should we be saying rather than listening to actually what they're saying, and it doesn't necessarily reveal our true personality. So like, when do you think that happened in your career? Like when did like you understand actually that people would be more interested in who Bob is than Bob saying the right thing?
Well, to tell you the truth, it happened right then. I mean, not to say I've been inauthentic my whole career, right?
Yeah.
But that notion of the really important thing that one should get out of an interview process is to figure out who the person is and whether that's somebody that you would trust to react to unpredictable circumstances, right? Because you can throw out a lot of scenarios, but you don't know what's going to happen 6 months down the road. And what you really want to know is, what's this guy made of? What does he believe in? What's important to him? And is this a person I would trust with my association? And so it really happened organically as that process was unfolding. And the notion, I mean, I guess, frankly, I came into the interview process in a pretty good position because I wasn't dying for the job. I'm really glad I got it, but I wasn't dying for it. I was in a really good position where I was. But I was certainly interested in it, and I certainly was, by the second interview, certainly wanted it. But I really wanted it only on the terms that they understood who I was versus, oh, maybe they could change who I am, or that I would have to be inauthentic in order to get the job done.
Like so listen, I'm looking at your career, and looking actually what you've done, from working at Pru, at Capital One, Chevy Chase, which by the way, BF Saul was a client of mine. They had a wholesale division, so I remember that. But all those companies, not to say actually your job wasn't mission critical, and that there was heavy weight with your position, but now actually everything matters. You make a mistake here, you destroy the housing. This is like, there's no room. So you're like, I get that pressure to say, all right, listen, it's got to be me, and this is the time to be vulnerable. So that is amazing. I got to say, like, that is good. So, all right. So I want to fast forward to here we are today. So here you've had 2 years of a lot of interesting things happening this year. Yes, and this year has just been insane. So talk to us a little bit about how the MBA changed, how it communicates with members, since the pandemic started hitting us.
Sure. We actually were in the midst of a study. We retained a consultant to help us understand whether the ways in which we communicate with our members was effective, and are there too many points of contact with MBA? Are we inadvertently flooding you with emails when that's not an effective way to communicate with you, and that sort of thing? And then when the pandemic started, and it was an intense game of whack-a-mole, where just when you think you get one thing settled, 3 more pop up. And what we decided was to, what I think some might consider over-communicate. And we started doing weekly calls with where the entire membership was invited. We started doing every other week calls with our leadership from our committees and our boards, our board of directors, as well as our commercial and our residential board of governors. And I'm going to actually quote you a couple numbers on that. We've had 15 all-member calls where 13,300 people have participated. And it's really, I lead it off, and then all the members of my senior management team talk about policy and legislation, and Mike Frantoni on the economy, that sort of thing. And then we've had 18 leadership calls with 1,900 people attending. And then really importantly, 81 webinars with 22,783 participants. And one thing we did before the pandemic, but it served us really well during the pandemic, is to increase the value of MBA membership. We made all webinars free. We used to have a, frankly, what some members considered a nuisance charge, $99 or something. We said, okay, forget it. This just comes with membership. And so we already were having increased interest in our webinars, but then we have been able to turn on a dime. And when a topic comes up, we can put together a webinar that has real content, useful information for our members within about 48 hours. And we've just had such success with that. So we have really tried to be much more nimble and much more inclusive. And if you're bored by an update, just either don't dial in or dial in and multitask. So we think we've met the mark in terms of communicating with our members through this crisis.
That's great. So, I mean, do you miss the in-person opportunities to meet people? I mean, like, really what is that? Do you think that takes away from your ability to connect with members?
I do. I'm old-fashioned in that way. I really prefer to be face-to-face. I like to have a drink or have a meal with members, understand what's on their mind. I feel like you can forge a much truer bond and frankly say things in person that you might be unwilling or reluctant to say via Zoom or on the phone. And while my wife is grateful that my travel schedule has slowed down, I really do. Every time, even though they're coming, every time you get another state association saying, well, the event is going to be virtual, of course, I'm happy to participate virtually, but I'm staring at a camera on a laptop instead of being in a room with a couple hundred people and getting to know what concerns them and what's going on in their parts of the country. So I really do miss that part of the job, and I'm anxious for it to return.
So, and can you talk a little bit about what what feedback you got from the MBA members? Because listen, it's very weird to be listen. May every year, I always was looking forward to the NBA coming to my city, and that was the greatest thing. And then, in October, we go to some random city but not necessarily random, but we go to some city actually that was random to me throughout the country. And it's a weird thing to not have, these two things that I've done for, I'm probably 15 years. How did you get the guidance on how to create a virtual event from the members, and what did they say that they wanted?
Well, I've really got to take my hat off to Marcia Davies and Elaine Howard, who've done a great job in not compromising one iota on the quality of the production and the quality of the content. And so we did secondary, I think we called it State of the Industry, but it was when secondary would have been, on a remote platform with the same production team we would have used had we been in New York. We weren't pinching pennies. It was, and I'm sure a lot of your viewers have been subjected to kind of slapdash productions, and this was top rate all the way. And that's of course what we'll do for annual too. So we had Bob Woodward. We didn't say, let's not waste any money on paid speakers. We had the same speaker we'd have had in person. And for our event that was going to be in Chicago and that will now be virtual in October, we have John Meacham, the presidential historian, who was just featured at the Democratic National Convention. And breaking news is that we have Andrew Young, the civil rights icon, former mayor of Atlanta and former ambassador to the UN, and the CEOs of Fannie and Freddie, et cetera. We've got the same kind of lineup that we would have had in person. and the production quality is going to be really high. And one of the hooks for, obviously we're not going to have Keith Urban signing guitars and passing them out to the crowd at an NBA Live event. Which
oh, no.
But other than that, we think that we're going to deliver real value. And if you sign up for the conference, you can, and you miss a part that you wanted to see, of course, we'll make available the recorded thing. So, and we're also encouraging groups, because one of the things is that if you had budgeted to fly to Chicago and spend a couple nights in the hotel and, maybe have an expensive meal or two, you're going to save that money. And what we're hoping people do is bring more people from their company to be able to experience the content and the production quality of a signature MBA event.
Yeah, my only problem is I thought this was going to be like a scaled down, event, but like I'm going to be facing the same problem of, do I go to this or do I go to this? This is not. That's my that's a dilemma, but
it's an embarrassment of riches. I'll take that any day.
Yes. Right, that's great. So listen, looking forward to the MBA annual. So I want to just talking about looking forward, to some of the things that we know we have to worry about. So first off, we have the adverse market fee. What are your thoughts on how we've reacted as an industry, and what the future lies ahead for that?
Well, this was the most stunning and ill-considered move I can imagine. In the midst of a pandemic,
don't sugarcoat it. Tell me what you really think, Bob.
Well, I'm a pretty measured guy. I went apeshit when this thing came out. Because you had the combination of an almost immediate effective date, right? I think 2 weeks. Yeah. In the midst of the fullest pipelines, probably in our lifetimes, and precious little explanation for why this was happening, and applying only to refinances, which generally speaking are lower risk than purchases. The whole thing didn't hold together, and it was going to cost the industry hundreds of millions of dollars, and it was going to catch unsuspecting refinance applicants off guard, because if you were floating your rate and you didn't lock, and the lenders hear that there's going to be a 50 basis point fee, that's getting added straight to your cost that day. So the whole thing didn't make any sense. So as you know, we swung into action with our Mortgage Action Alliance. We produced 86,000 letters to the House and the Senate. We worked, of course, very closely with industry partners to sound the alarm on this. And I'll skip some of the details, but I think where we ended up, which is an acknowledgement that Fannie and Freddie will have costs by extending this relief through the pandemic, and that it's not inappropriate for their revenue to increase to help compensate for those costs, but to do it in a way that protects the pipeline and protects consumers with that new December 1st implementation date. And very importantly, and I feel very strongly about this and lobbied personally for it, exempts the people least able to afford it. So we got Home Ready and Home Possible, which are only geared to only allow borrowers who make below 80% of the area median income. Those programs are exempt, as are loans below $125,000. Well, that's not a perfect proxy for lower income. It certainly includes many, many borrowers whose income is at a lower moderate level. So we were really pleased with the outcome, disappointed that we had to mobilize in such a public way to get it, but really pleased with how that worked out. And I think our members were too.
Wonderful. So are you worried at all about forbearances? As actually, a lot of the forbearances have now, come to the end. Are we going to see a deluge of defaults and potentially modifications? What is your feeling about forbearances and potential defaults?
Well, just to be clear, none of them have really come to the end, because while the initial period might have been 90 days, they can be extended for up to 12 months. So they started in, I guess, March or April. So it really won't be until March or April of 2021 that people are out of time if their hardship persists for that long. And so Mike Fratelli and his team here at MBA puts out weekly data that shows that forbearances have come down, and it also tracks what the exits are from forbearance. And typically, anywhere between 80 and 85% of the exits are for what we call good reasons. It means the loan was paid off, or the borrower reinstated, meaning made up the forborne payment or payments, or that they went on a payment deferral plan through the agencies or a partial claim plan through FHA. So in other words, their hardship was resolved. They were able to resume making their payments. Now, these are still early days, and so those may be borrowers who were, let's say, furloughed and then called back, that sort of thing. But there certainly will be, come March or April, when we are at the end of the extensions, there certainly will be borrowers who have not recovered. And at that point, I do think we're going to have low rates as a wind at our back, so that modifications can be one way out. But obviously, there'll be some borrowers who simply don't have any income and have no way to continue. So another positive thing compared to the Great Recession is that a very high percentage of loans have equity. So if the borrower comes to that unfortunate point, many of them could sell the house and not result in a loss to the lender, and maybe even give the borrower a little money to walk away. But there certainly will be some where foreclosure will be the inevitable result. So early indications are quite positive, but we've got a long way to go.
Yeah. Yeah, well, I'm sure we won't see the mass amount of short sales like we saw. So that's definitely good. So, all right. So I know actually we've kind of I feel like on the GSE patch we've kind of kicked the can down the road a little bit more. Talk to us a little bit about so we've got we don't have to worry about the 2021 deadline, but I feel like we don't have clarity about what it actually is going to look like in the future.
Well, I think it's pretty clear how it's going to look. The proposed rule that the CFPB put out did lean quite heavily to moving to a construct where, rather than using a single credit variable, the debt to income ratio, the 43% cap, they would look at price, because what we've seen is that loans priced in a certain way, and the magic number currently is 200 basis. Well, it's in the current statute, it's 150, but we've advocated with broad support that it go to 200 basis points over the APOR. That loans priced there generally perform well and show that the borrower's ability to repay has indeed been assessed and deemed reasonable. So I think the Bureau is headed in that direction. As you know, comments were just due on, I guess, yesterday. We've submitted ours, of course, and I'm sure that the Bureau will have a lot of them to digest. But it's pretty clear that, first of all, they're not going to let a gap occur, right? If this takes past January to get implemented, they'll extend the current patch. And secondly, that the single variable DTI construct, with its reliance on the outdated and unworkable Appendix Q, is going to go away. I mean, I think that's pretty clear. So we've advocated that be the case. We think we are also advocating that the safe harbor be raised to that 200 basis points over APOR, because the market has shown since the patch was put in that there's not a whole lot of appetite for making loans over the safe harbor. In other words, at that rebuttable presumption level, I think it's less than 5% of conventional originations have been there. So the idea is to push the APOR up to push the level up to 200 over APOR. That will ensure that people who might have higher loan level price adjustments or risk-based MI premiums are not denied access to the conventional market, and we're optimistic about the outcome.
That's good. I know there's a lot of non-QM lenders that are just disappointed by that, but I think it's the best thing for our industry and the borrowers. So,
well, let me just say to that point, I think that there's plenty of room for good loans to creditworthy borrowers that are sustainable that will be non-QM. And
Yeah.
partly it will be that the borrower is unable to provide what the QM ability to repay standard would consider verification of income. For instance, if there's a bank statement program, now I'm not sure, I think a 1-month bank statement program is very smart, but if you have a 12-month bank statement program, that would not qualify you for a QM loan.
Yeah.
I think the market will continue to absorb loans to creditworthy borrowers who have income that's difficult to verify in the traditional way. So I still think there'll be space for non-QM loans.
Yeah, and I think actually, I think that the so in a case, if it was a 1-month bank statement, at least actually, you're finding higher LTVs, higher rates. So it is actually, it's more appropriately priced, and the other factors are in play that just weren't there when we had a mortgage meltdown. So
Right.
wonderful. So listen, Bob, it's been an unbelievable year. Looking forward to connecting with you. Now, is at the MBA annual, is there actual opportunities to network with other professionals?
Yes. Thank you for bringing that up. We're going to have a virtual exhibit hall, which might be a little hard to get your arms around, but it's simply a way that you can make appointments with the vendors who are going to be in our exhibit hall and get to have one-on-one meetings with them for them to be able to discuss their offerings, similar to the way you would if you roamed through the exhibit hall and stopped at their booth, only probably with fewer distractions when you're able to do it one-on-one virtually. And there's also going to be all kinds of, I haven't yet seen all the details on the technology, but there'll be all kinds of ways of networking and meeting up with your colleagues that will try to replicate the feel of an in-person event. And we know it will never be the same. We're anxious to get back to the way it was, but we really think that it'll be a valuable experience and provide plenty of networking opportunities. Now, it won't be at a bar, and I think it's hard to mask up when you're at a bar, so we're not doing that. But we are going to be sending everybody who registers something that will remind them of the Chicago experience, so that they can at least do some toasting from their own locations.
Oh, that's great. That's wonderful. Looking forward to it, Bob. It's always great to connect with you. Thank you for all the amazing work that you've done. And I really appreciate you sharing your story with us today.
Oh, you're so welcome. I'm happy to do it. Take care.
All right, thanks. And I'm Andrew Berman for NMP TV and National Mortgage Professional Magazine. Thank you for watching another Mortgage Leadership Outlook. We come to you every Wednesday, 4 o'clock East Coast time, 1 o'clock Pacific time. Everyone stay safe out there.